Hello everyone and welcome to this lunchtime learning session hosted by Skipton Building Society. The current mortgage market with heightened mortgage rates, high house prices and elevated rent along with tightened affordability aggravate challenges already faced by first-time buyers. Both brokers and borrowers have been crying out for innovative solutions and products to combat these challenges and support this vital segment. Skipton's track record mortgage made waves in the market earlier this year with its 100% LTV structure and critically the inclusion of rental track history, with the product aiming to help those trapped in rental cycles. However, it's not the only solution out there that can help first-time buyers, with joint borrower, sole proprietor and shared ownership also having their place. Today's session will look at the launch and evolution of Skipton's track record mortgage product and other options available for first-time buyers. We hope that by the end of this session, you'll be better equipped to help your first-time buyer clients. I'm joined today by Jennifer Lloyd, Head of Mortgage Products at Skipton, and John Scrivens, New Build and First-Time Buyer Lead at Skipton. There is a Q&A at the end of the session, so if you want to submit a question, click the Ask a Question tab on the left-hand side. And without further ado, I'll hand it over to Jennifer and John to kick off this session. Over to you guys.
Yeah, thank you very much, Anna, and good morning, good afternoon, everybody. Hope you're all having a great Tuesday. You can't see me right now, but I'm definitely sat here with a warm coffee, ready to go and to get started and talking to you about first-time buyers and specifically some of the challenges facing first-time buyers today. At Skipton, we've also been talking to a lot of our first-time buyer customers, really trying to understand the challenges that they face today, but also looking to try and provide some solutions to some of those challenges. But what I thought would be good is to kind of start with regards to some of those, and you probably think some obvious challenges that are maybe not necessarily new and have been faced by first-time buyers over the decades. Certainly, I can remember when I was a first-time buyer, some of those challenges around raising your deposit or the affordability issues are still very much here now. But what hopefully over the next 30 minutes or so, Jen and I'd like to share with you is some of those challenges, but also some of the innovation that we and also the industry is looking to address. As Anna said, please, I'm going to talk to you for the next 10 minutes or so and hand over to Jen. But we do have a Q&A session at the end, so get those questions in, and we will absolutely do our best to navigate through those later on during this conversation. So without any further ado, with regards to some of those dynamics that are affecting the customers, first-time buyers at the moment, you could say that the market is flat. You could say that the last 6 months has been a really challenging time for everybody through the cost of living crisis, through what we've seen with the funding markets, with the Bank of England putting rates up. Have we seen the top of that interest rate climb from the Bank of England? But predominantly, there's definitely still the two market dynamics that affect first-time buyers the most, which is both trying to prove affordability for the loans, but also trying to arrange to raise deposits. So sharing with you now, on the left-hand side of the screen, you've absolutely all been through this over the last few years, I'm sure. But what we've seen is some of quite possibly the lowest interest rates in history for customers, which has been a phenomenal time to be alive and to be arranging a mortgage for your purchase. But as they set the old adage say, all good things must come to an end, and we've certainly seen the end of historical low interest rates, and as you can see there, back in September 21, you're looking at fixed rates for 2 years at near or under, in I believe a couple of times 1%, which was absolutely phenomenal. And I guess we've all become accustomed to those low interest rates. But as I said, all good things must come to an end. We saw the mini budget back end of last year peak rates above the dotted line there at just over 4%. We've seen rates increase up into the 6% mark. And all of that absolutely comes at a price to all of us. But what I thought was interesting, the graph on the right, very kindly provided by our friends at Zoopla, it shows you the true impact on the borrowing power of a first-time buyer. So the examples there, I think they certainly stood out to me when I was reflecting on what to talk to you all about today. And this example here shows back when rates were only 2%. And a customer looking to buy a property at 200,000, requiring a 95% mortgage or so, at 2%, their borrowing power was 193,500 pounds. Fast forward through the 1%, 2%, 3%, 4% rises to what we've seen to Bank of England to today. Actually, the borrowing power for the average first-time buyer is actually down 35%. So somebody wanting to buy at 200,000, but against the interest rates of today's climate, you can see that it massively affects the borrowing ability for that customer. So that's really difficult, and we at Skipton acknowledge that, and I'm sure you all are having some really tough conversations with potential house buyers or excited house buyers looking to buy their first home and get onto the housing market, only to be having some really difficult conversations with them to manage expectations. But that's exactly why I believe customers need advice to explore the plethora of options available to them through the different mortgage solutions that we're going to talk about today. What I wanted to share with you as well is just kind of put you in the shoes of the customer around the UK, because actually we see in the press some house price indexes where we're seeing slight reductions in prices, but it's very much geographical, and we are seeing kind of post-pandemic effects still of both the ability to borrow through income stresses, through the house price inflation over a quarterly basis and annual. But just to talk through the three illustrations on the map, and they are a bit confusing, so I will talk through them one by one because the color coding does change. So firstly, on the left-hand side of the screen, the map of the UK, what that illustrates is the redder the colour goes, so from dark green through to red, illustrates to you throughout the UK the income needed in order to buy. So as you can see, and as you would imagine, it's never going to be cheap to buy in the capital, in London. You can see the outreaches of the map there in the red colours, that it is the still the most expensive place to buy, and also needing the most income. But you can see as you stretch out up the country and across into Wales, you can see the household income needed to buy does come down. The picture to the one in the middle, the picture of the UK in the middle, actually let's change the graphic in terms of the colours. Actually, what this shows is the red colour shows the quarterly house price inflation, and this is back into June when the latest figures were released. Back into June, you can see the effect on the house prices for that quarter, and anything in red actually shows a neutral growth, but anything in dark green shows where there's an above average inflation growth. And you can see there in parts of Scotland and actually in central London, you can see property prices have increased. And then finally onto the graph on the map onto the right, you can see the annual house price inflation. And actually what we can see here, again, dark green is where we've seen above 1.5% increase in house prices over that period. And you can see parts of Wales, you can see in the southwest, Devon, Cornwall, where post-pandemic or during the pandemic to kind of the early parts of getting back out and about again, we actually saw that a lot of people were moving and actually fancied the dream of living by the coast. But actually over the last 12 months, we've seen property prices in those regions see some of the largest declines in valuation. So that's kind of a bit of a picture of the UK in terms of what's happening to the housing market. But what I wanted to do is share with you some research. So again, putting you very much into the of the customer, understanding some of those challenges faced. And I'm going to talk to you in particular about the bank of family, and I say bank of family intentionally because it used to be the bank of mum and dad. But what we've done is we've actually spoke with in connection with Hampton's estate agency, spoke with a number of our customers over the last 12 months. These are customers that have come to Skipton that are first-time buyers. And what I'd like to do is just share with you some of the trends that we're seeing in terms of how these customers are behaving, and most importantly, how they're raising deposits. So for information, Legal & General shared fairly recently that the Bank of Family is now worth a staggering £8.1 billion so far in 2023. And to put that into context, that's 318,400 properties, which is actually up. So the Bank of Mum and Dad, Bank of Family now worth 8.1 billion this year, and only 4 years ago, or not even 4 years ago, back in 2020, 3 years ago, it's up from 4 billion. So that's staggering. That's double over what is quite a short space of time. And what we found from talking to our customers, our first-time buyers, that 32% of mortgage first-time buyers receive family support towards a deposit this year, and that's up from 30% in 2022. Some of the main changes in terms of, as you can see from the graph in front of you, what we're seeing is that parents are contributing less of a deposit these days, and actually what we've seen is an 8% drop over the period of over the last 5 years. So in 2023, 72% of of people that have had a gift from a family member has come from parents, and actually grandparents has changed as well. So we're seeing grandparents gifting less from 10% in 2020 and in 2017 down to 8% this year. But the biggest change, and there's probably lots of reasons for this, and we might come into it in the Q&A later, but the biggest change that we're seeing is actually from siblings, from brothers and sisters who are clearly being more generous than mine would have done. But what we're seeing is we're seeing a rise. So from 5 years ago, from 5% of siblings gifting a deposit, now in 2023 up to 11%. So it's quite a big change. We're not talking small numbers here. So also worth noting that the Bank of Family is gifting on average £15,250 to their loved ones, and that's again certainly not to be sniffed at. And what we're finding from the research that we've done is it's not just the 5% deposit that's being given; it's actually considerably more in places, which is obviously helping that family member get a cheaper mortgage and a lower loan to value. In terms of kind of conclusion from our findings, not every family member has a Bank of Family to help them out. So for me, there's a big challenge here with regards to social mobility in terms of how do we at Skipton help all first-time buyers, and not just first-time buyers that have got family wealth in order to pass on. As home ownership rates decline through the generations, younger parents today are less likely to be homeowners than their predecessors, thus reducing their ability to withdraw any equity and help their sons and daughters in the future. We expect that actually the higher interest rate environment for customers to really for wannabe gifters to really make things difficult as well. And actually we all experience the pinch of today's interest rate environment. So I guess in conclusion, we understand that the Bank of Family is really important to some people, not everybody. We've done a lot of research, and we can see that the Bank of Mum and Dad has already changed to the Bank of Family. And will we see that continue? And I guess it would be easy to conclude and say, the market for first-time buyers is tough today, which it is, but it's not all bad. And what I'd like to do right now is hand you over to my colleague, Jen, the head of mortgage products here at Skipton Building Society, to talk to you a little bit more about first-time buyer market, what we're seeing today, and how at Skipton we're looking to help more people into home ownership. Jen, over to you.
Thanks, John, and good afternoon, everybody. Lovely to be here with you all today. And I'll just reiterate that we are very keen to hear your questions, so please do submit them in the chat and we will get to them at the end. Before I talk about track record specifically, I thought just picking up on what John was saying around the market, I mean, brokers on the line are well aware that the market is reduced year on year after a epic level of volume kind of seen after the lockdowns that we all went through. And I think it's fair to say that whilst the residential market is about 30% reduced year on year in terms of applications, what's really encouraging is the segment that's holding up most strongly is from first-time buyers. And I think it gives me a lot of comfort. And I think it also just shows that actually for people that are keen to take that first step onto the property ladder, regardless of the additional pressures and the fact that finances are under pressure and that rates are higher, houses are still expensive, that will is still there from first-time buyers, and we very much recognise that at Skipton, which is one of the reasons that we wanted to develop a innovative product solution where we saw a gap in the market. Next slide, please, John. And so in terms of where it all began from a track record point of view, Skipton Building Society was founded in 1853, and we were founded for one reason, and that was to help people into home ownership. And here we are 170 years later doing just that, albeit different ways. You know, it needs some different thinking. It's far less straightforward than it once was. We absolutely recognise that. And so we wanted to think about what can we do to support people to access the housing ladder. And just touching on what John talked about, we know that the Bank of Mum and Dad is a huge, one of the top 10 lenders in the UK now, but there are many, many people out there who don't have access to family wealth. And so for those people, what could we do to bring a product to market to help them to access the property ladder? And so that's where Track Record came in. Next slide, please, John. So we did some research. We obviously do lots of research, and we talk to prospective borrowers about their needs and their circumstances. And our latest research we did in March of this year, and the findings were quite stark, really. And the big one for me was that 80% of renters feel trapped in the rental market as it is. We know in the UK there are over 3 million resentful renters, and what that means is there are people that are living in rented accommodation that would like to own their own home, but for a number of reasons can't or don't believe that they can actually take that first step onto the housing ladder. And the market dynamics that John talked you through, whilst yes, house prices have softened slightly, they are still elevated, and actually we're yet to see an actual fall in house price on a kind of national level. Looking at ONS data, we can see that the absolute peak of house price inflation was around 14-15% back in 2022. But even as recently as July, we're still in a growth phase. So it's 0.6% year on year as of July. So that is vastly reduced from the peaks that we were seeing post-pandemic, but it's still a rise. And so that kind of compounds the issue, which is that for first-time buyers, they've got house prices that are continuing to go up and remain elevated. And we know now that the average price of a property is around 8 times income. So thinking about that in real terms, that means that the prospect of, you know, hitting that affordability, when you look at all different lenders out there, you know, we know that the average loan to income is around 4 times, 4.5, maybe up to 5 if you're lucky, but certainly not 8 times. And so that's one of the challenges. And we also heard from our customers that we spoke to around themes struggling to save a deposit, because as we've talked about, the cost of living crisis continues. People are struggling to pay for food and to fill their cars with fuel. And so the prospect of saving a huge deposit is potentially feeling out of reach. And that's where Track Record came in. Next slide, please, John. This data here just shows you in a snapshot kind of the reality for a lot of people that are trapped in the rental cycle. And you can see there, and again, this hasn't been updated for a couple of months, and actually rents are rising. So that needs to be about kind of referenced, I would say. Rents continue to rise. The average rent in the UK is up 5% year on year. But actually, as of last month, rents have risen 12% in the last month, which means that the average cost of rental is now £1,304 per calendar month. That's outside of London, I would just also like to caveat. So you've got that dynamic at play. And then you also have the fact that for every property, there are probably around 30 people that want that property, which means that is kind of keeping the pressure on that sustained rental growth. So therefore, we very much acknowledge that people who are trapped in renting, who are saving, attempting to kind of finance their lifestyles and continue to cover their basic needs and running a household, the prospect of saving even a 5% deposit whilst paying those rents is potentially far out of reach. And you can see on that graphic there, I think in London, people in London, as we all know, have it the worst in terms of affordability and rent. And so if you're living in London at the moment, you're looking at around 13 years to save up a deposit that you'd need to buy a property in our capital, which is inconceivable by all accounts. So that's where Track Record came in. Next slide, please, John. So we launched Track Record back in May of this year, and it's fair to say that we've been overwhelmed and thrilled with the response that we've seen. So the product, in a nutshell, hopefully everyone on the line has heard about it, but essentially it is a fixed rate mortgage that requires no deposit from the borrower, providing that they can demonstrate that they've been paying their rent for 12 months in a row within the last 18 months. So that even means that if somebody was very recently in rented accommodation but moved home to potentially start trying to save more, as long as that was in the last 6 months, they can absolutely apply as well. Equally, if there is a small deposit in place, we absolutely accept that for the product. So you can put down a 1%, 2% deposit, but anything under 5 is absolutely fine to be eligible for the product. And it's been really, really heartening to see how positively it's been received in the market. I think very much there's more of this innovation needed from the industry as a whole. And it's fair to say that we absolutely would welcome other lenders kind of joining us in the provision of this type of product. And we can't do it all on our own, but we were happy to kind of take the lead. And then the only update on Track Record, I would say, is that in September of this year, so this month, in fact, we have had feedback consistently from the broker population in terms of the product and the fact that it was only available to first-time buyers specifically. It didn't cater for those people that maybe are living in rented accommodation but have previously owned in the past. So people that have fallen off the housing ladder for whatever reason, that could be due to change of circumstances or divorce or change in family situation. So we listened to that feedback, and I'm thrilled to confirm that we now also offer the Track Record mortgage to borrowers who are not first-time buyers, people who have previously owned property, as long as that has not been in the last 3 years. And that's been really, really well received. And we forecast that we might see as much as double the level of volume on the product now that we account for those borrowers as well. And then if I bring it to life with some real life examples, we've completed, I think that's actually out of date in terms of the number of completions we've done so far. We've done a few more. The figures that I can share are that we have helped now over 500 people in terms of applications for the Track Record mortgage. That is, of course, due to the fact that a lot of people are buying with multiple applicants on one case. And in terms of completions, we've helped over 150 first-time buyers get the keys to their first home, which is absolutely brilliant, and we hope to see more of it to come. In terms of thinking about the real life impact, it's been great that we've had those stories shared with borrowers that used our product to access the ladder. And there's an example on the slide there, a young couple who were looking to kind of get onto the ladder for the first time. And they also had an update from their landlord, which was that the rent was going to be increasing quite dramatically. And for them, you know, they took that as quite a worrying time and were thinking, well, we're never going to save for a deposit now. What are we going to do? And actually, with the launch of the Track Record mortgage and the fact they didn't need a deposit and they'd been paying their rent every month on time, they were actually able to borrow £243,000 to buy their very own 2-bedroom flat. And encouragingly as well, their mortgage payment is actually lower than their rent. So that's an added bonus. So they're actually paying out less in terms of their mortgage payment than they were with their rent. And you can see a quote there from Layla, who was one of the buyers. And it's been great to hear. I think something else that I would always draw your attention to, and it's something that I only started thinking about last week, is around when we see those classic side-by-side comparisons between the cost of renting versus the cost of buying. People often look at it in very much kind of side by side. So you'll look at how much is the total mortgage payment and how much is the total rent payment. But actually, what's really important to recognise is that that isn't really a fair comparison, because when you're paying a rent, 100% of that money goes to your landlord. However, with a mortgage payment, yes, you have some interest to pay, but every month you're also paying off capital, which means that you're going to be putting into that house as your investment for the future. So actually, a better comparison to make side by side is to think about what is my rent versus what is my total interest that I'm paying. And that actually means that it can often be that even if your overall mortgage payment is looking like it's potentially equatable to your rent, or even potentially going to be higher in the future, it's about the investment that you're making for your long-term security and having that kind of home ownership, which is really heartening. And if we move on to kind of our broader first-time buyer proposition, and also thinking about what it's been great to see from an industry point of view, the track record is obviously the first of its kind for a very long time in terms of 100% lending, and it's definitely the first of its kind that acknowledges rental performance in terms of assessment. I think joint borrower sole proprietor is also going to be an area that we see more growth in. I think one challenge that we have with that is that whilst ourselves in the industry are quite comfortable with what JBSP stands for, I don't suppose the average first-time buyer would have any clue what that would mean. And so I think there's a challenge for us all as lenders to work to not only bring innovative solutions to market, but also think about how do we explain what they are in a way that's accessible and means that those people that are thinking about maybe home ownership isn't for me right now could maybe think again. And that's where brokers come in and can offer that kind of guidance and expert help. I think shared ownership, similarly, we're going to see growth in that area. It's thinking differently and innovatively about what home ownership means. Gone are the days that you could buy a house for £1,000 and still have, 3/4 of your annual take-home pay left over. That is not where we're at anymore. And so actually, why not shared ownership? Why not start out by owning a part of a home and then work your way towards full ownership if that's right for you? I think we're seeing definitely extension of mortgage terms. It used to be very much when I started out even that 25 years was a standard mortgage term. We're now lending up to 40 years, and that's there to help with affordability. And what we see in our data is actually, whilst you might take out a mortgage on 40 years to begin with, as you continue to review your mortgage, your earning power increases and that term comes down, which is excellent. We've talked about high LTV lending, that's here to stay. And I think it's a really important part of what we do at Skipton. But as an industry, there's plenty of people still supporting at 95% loan to value. Long may that continue. And finally, the government scheme products. So I think at Skipton, we very much support all government schemes and have in the past with things like Help to Buy. And again, it's just important that we continue to have those schemes available from the government to continue to give that vote of confidence to people that are looking to access the property ladder. So that, in a nutshell, is the content that we had to go through with you this afternoon. But we're very keen to get into some Q&A if we can do that. We'll move to that now.
So on the presentation, it talked about how many completions the track record mortgage had, and you said it's about 83. And that might be even higher. But I was just wondering, were there any specific, obviously first-time buyers, it is a product for first-time buyers, but were there any particular geographies or any particular areas that there were more applications from was it like more applications from the south or kind of more
local?
I
think we've been really encouraged actually that we've had good geographical spread of applications and completions right up and down the UK, and a real good spread of income and kind of case size. So we've had the maximum case size is 600,000, and we have had applications and completions at that upper end. We've also seen more affordable houses bought using the product, and so I think the average case size at the moment is about £160,000. We do acknowledge that the product works best where house prices are more in line with rent. It's a fact of how it is. I do hope, though, however, that we are starting to see mortgage rates come down and rents are going up. So actually, I hope that in time, we're here to stay with this product, and so hopefully we'll start to see that kind of improvement in terms of rent to mortgage payment, which will open the product up for more first-time buyers.
And Anna, just to add as well on to Jen's comments from the research that we did before. This is way before we brought the product out. So talking to 2,000 renters, 48% of them said that they would be willing to sacrifice something from their current rental situation. So 48% of people said that we would happily relocate in order to own our own property. They may have been, trapped in a city dwelling, that actually, you know what, they could move out of the city, live in a more rural setting, but know that they then need to commute weekly or whatever. And so almost 50% of the people that we spoke to said, do you know what, actually I'm willing to give something up in order to get, it's fundamentally one of it's a British or a British constitution, isn't it, to own your own home. And people aspire to that. So the research told us that, and that's from the stories that we hear. That's what they're doing.
Great. That's really interesting. John, if you could just turn your camera on as well. For some reason I can't see you, but we can hear you, so that's great. Jen, you mentioned in the presentation that you would really welcome other lenders coming into the 100% LTV space. It just be, you know, I suppose I'm wondering, again, this might be a silly question, but kind of what are the kind of I say worries is a strong word, but kind of the hesitancy for other lenders to enter this space. And I suppose, were they just waiting for Skipton to kind of pave the way and see what the kind of...
Well, that's certainly what we hope for. You know, we are an incredibly responsible and financially strong lender. And so, you know, we made sure that we did everything that we needed to do to get ourselves comfortable with this type of lending. And yeah, we hope that others follow in our footsteps, you know, sooner rather than later, because, you know, we are punching above our weight in terms of market share this year. And, you know, we're happy to lead the way, but it would be really, really great if people could follow, and not just with 100% lending. It's just continuing to innovate and think a bit differently about what can we offer as lenders in terms of products, but also propositionally, criteria. What can we do that acknowledges and recognises that buying a house today is very different to buying a house was even 10, 15 years ago.
Yeah. It's funny, my mum... Sorry, you go.
Yeah, sorry, Anna. I was just going to say, and again, going back to the data that I shared at the beginning of this conversation, 32% of our first-time buyers received a gift from a bank of family, and yeah, that's not fair. That not everybody has that ability. So, I absolutely hope that others will get involved, and if they don't come up with exactly the same thing, come up with something that will address that issue.
Great. And the rental history aspect of this is really kind of what sets it apart. Do you think that that's something that should be more widely kind of accepted across the industry as kind of, it seems like quite a crucial part of someone's expenditure, that it's not that it's not considered, it's just not integrated in this, as far as I understand, not integrated to the same extent as the track record mortgages?
That's correct. Yeah, we're not aware that any other lenders are currently kind of utilising rental history in the same way. I do think that will change. And I think, you know, it's been a long held confusion, and rightly so, between, you know, the industry and first time buyers at large, when they say, you know, my rent is this amount, my mortgage will be less. Why can't I have a mortgage? Like, I've been paying my rent for all this time and I've got my track record. Why will nobody acknowledge that? And I think that, yes, I know that from other lenders, there is development in the industry in terms of thinking about assessing affordability with things like open finance and things like Experian Boost. There's definitely innovation going on to make sure that we are looking at first-time buyers holistically and not in the old-fashioned way that we once did.
And affordability is kind of something that you both talked about quite a lot. And are there other areas of affordability that need more improvement or innovation, or any other kind of things that could be more could be looked at to benefit first-time buyers?
Yeah, I would say so. I think that, again, we, as an industry, we sometimes tend to have a bit of a one-size-fits-all approach to affordability assessments and the way we look at kind of even criteria. And I think that I'd certainly be interested to explore kind of a more tailored approach, because what, as we've said at the beginning of this conversation, what works in Skipton is not going to work in London. It isn't the same. And so there should be potentially a little bit more nuance in terms of what lenders are expecting and asking for and taking into account when they are assessing affordability. So yeah, no, I look forward to seeing that continue to innovate as we go through the next year and beyond, definitely.
One thing that whilst I was researching for this masterclass was obviously you have new lenders like Proprietor who want to do longer term fixed rates of, you know, not just of 20 to 30 years. Do you think that you know, that could be something, and long term fixed rates haven't been popular in the UK market, it's usually 2 or 5. Do you think that that's kind of something that could grow in popularity? Just interested to get your thoughts on that, both Jen and John.
Yeah, I think the challenge that we've got at the moment, I think it's great that Proprietor have got, to market, and that's wonderful, and they've been looking to that for quite some time. So it's brilliant that they're there. I think the challenge that we have is whilst interest rates have started to come off a little bit, and we're seeing those sub 5% on the market again, I mean, they are still for very low LTV. So, your average first-time buyer does not have a 40% deposit, so they're not going to access that sub 5% rate quite yet. But I think even with that in mind, there's a general reluctance to lock in a fixed rate right now at what we think is potentially, the peak of Bank of England base rate or very near that. It's quite a difficult way of kind of going about it. It's already a shift in terms of, like you said, Anna, people tend to go for 2 or 5 year fixed rate products as a rule in the UK. So the time to move out into 20 or 30 year fixed rate products at a time where rates are still quite high, I'm just not sure the appetite is there from consumers. It does have benefits because, of course, when you think about things like stress testing, if you know what your mortgage payment will be for 30 years, then there's no need to assume any uplift on that because you've got that locked in for 30 years. So there are benefits. You can be more flexible with things like loan to income, as I know Generation Home have been with Nottingham. But I think generally, long-term fixed rates might start to play a role, but I don't see that happening anytime soon. I'm also kicking myself that I didn't take out a 10-year fixed rate back a few, like not even that long ago, 1.6. What was I thinking of? I thought that was a bit steep. I won't bother. But, here we are.
Great. John, did you want to add something?
Yeah, no, I've got nothing further to add than Jen's mentioned.
We've got a question in from the audience, which is for the track record mortgage, if we've got clients that have 100% track record in terms of rental income, but a couple of missed credit payments, is this a potential scenario that can be considered?
I would say have a talk to your BDM about individual cases. I don't know, John, if you want to come in on this one, but generally speaking, this product is around helping with lack of deposit. I think there's still more that can be done in terms of less than kind of immaculate credit history. But I don't know, John, have you got anything to add on that?
Yeah, I think just going back a couple of questions ago in terms of this, the product, the track record product is the rental payment is part of the route to the product, but it's not the only route. Obviously, we still apply all of the normal rigor to the underwriting process. So we look at affordability. We still need to go through the affordability calculator. So we still need to ensure that it's affordable for the customer. And in fact, because as anybody listening, because it's a higher loan to value mortgage, it's clearly going to be therefore a requirement for that customer to have a really good credit rating. So normal rules apply really. Either refer to your BDM or refer to our website. It's really clear with when we were designing the products and involved in the conversations from outset. One thing we wanted to be really clear to the broker and to the customer was who it is for. So check our website. It's got really clear qualifying criteria, and therefore, if it's really clear for who it's for, it's also really clear for the types of client. It will be harder to hit all of the limits.
Well, another question we've got in is what are the barriers to true intergenerational mortgages, i.e. intergenerational offset? Is it regulation or lender capability? That might be quite an interesting one. Don't know who wants to take that first.
Yeah, I think actually offset is, I'm very young, Anna, so offset mortgages haven't really been a thing since I've been working in the mortgage industry. But actually, historically, we know they've been really, really popular with people. And I think when we were in a very historically low kind of benign rate environment, savings rates were just so low, it didn't feasibly make sense in terms of an offset. However, we're not there now. And I think that very much on our agenda, certainly from Skipton's perspective, is thinking about, yes, we've got track record for no deposit. How do we help link together generations in families where there is wealth? Maybe it's not accessible cash, maybe it's equity. What can we do there? And then thinking about if there is that family wealth and there's cash available, is there an option to kind of think about an offset coming back? So yeah, it's on our list, I would say, for sure. And I think it will probably, like I say, it will grow in popularity. Any sort of innovation and thinking differently about connecting the wealth that is there, I'd welcome that for sure.
Anna, I'd just add the joint borrower sole proprietor proposition, not just at Skipton, but in the market, has been a fantastic evolution. So I think sometimes we can kick ourselves and say as an industry we don't change a lot, which, well, to be fair, we haven't in certain places, but we have innovated in a number of different ways. And actually the joint borrower sole proprietor proposition is, and I absolutely applaud the intermediary market for creativity in terms of how they're helping customers, because when we came to market with a joint borrower sole proprietor proposition, predominantly aimed at first-time buyers trying to get some help from a family member. But actually what we've seen a lot of that, but we've also seen a lot of customers that have had interest-only mortgages of old, who are coming to the end of their term on an interest-only mortgage, and actually they no longer need to downsize and sell. Actually, there's ways and means of asking younger family members to support that mortgage application from an affordability perspective. So I guess my point is that there has been evolution and some new ways of working through things like JBSP. And absolutely, if anybody listening has got any queries or questions on the criteria and some examples, again, get in contact, reach out. But also on our website, we've got some great stuff.
Yeah, I think that's the thing, is sometimes we don't toot our own horn enough about the things that are available. Like Jen said earlier, joint borrower sole proprietor, it might not be part of the mainstream. People might not know exactly what it means, but that's where brokers come in to kind of explain how it can apply to different people in different situations. So a bit more of a tricky one here. Obviously the autumn statement's coming up. Do you think there will be any announcements about to help first-time buyers or the housing market in general? Do you just kind of want the government to leave the housing market alone? Because the last time they did something, it didn't necessarily go very well.
No, they can't leave it alone, Anna. They can't leave it alone. I think everyone will be aware that we are in a quite interesting time politically at the moment, because we are looking at a general election. Everyone expects it to be next year. I think it's like January 25, the absolute latest it would have to be done. So yeah, there's going to be a general election. And so I don't know if I'm a little bit skeptical, but I feel that some of the announcements that we might see are kind of really a bit more of people's manifestos, airing out some kind of, draft manifesto pledges. And I think that, yes, the government absolutely have a role to play. There's a kind of systemic issue in the housing market, which is there isn't enough houses. Like that's just a problem. And I do think that some of it is on the government to do more to support that and stimulate that. There's also tons and tons of unoccupied properties that are not being looked at, and that's another thing that the government could do to help. But I also understand that there are other things top of mind for the likes of Rishi Sunak. So I think for me, I know we've heard some rumours about Help to Buy coming back. Personally, I don't think we'll see that anytime soon. But even if we do, how quickly could that be brought back to market? I think that given what's happening from an election point of view, the likelihood of any real kind of game-changing legislation is probably a little while down the road. But in the meantime, the industry will do everything that we can to do our part for sure.
Yeah. John, do you have anything to add to that? Any predictions, or what would you like to see the government do, or any announcements?
Anna, so without getting on a soapbox, I think coming back to Jen's point, there's simply in England, Wales, and Scotland, we are not building enough new properties in order to keep up with demand. Therefore, net effect, the stock that we've got is going up in value. It's making it harder for people to get onto the housing ladder. We have a social mobility issue with regards to some families have got intergenerational wealth, some haven't. So do you know what? They need to stop talking about it and get on with it.
Yeah, I think that's a good note to end on there. So I think, key takeaways for me is that the track record mortgage is, it's going very well. It's got good number of completions. There's a good geographical spread. There are definitely challenges for first-time buyers around saving the deposit and also house prices being higher. But there are solutions out there, and you as brokers are best positioned to kind of help and check out Skipton, talk to your BDM, look on the website to see if their solutions will suit you. So I Thank you so much to Jen and John for joining us today, and I'll let you guys get back to your busy day to your busy days. Thank you so much.
Thanks, Anna.
Thank you.